Okay, this is a pretty important concept. It's the shutdown point. When businesses are operating and they're not making money, there is a point which they need to consider whether they are staying in business or not. And that is broken down into two possibilities: not staying in business for a short period of time to go through a recovery, or just not staying in business for the long term. All right. Now, the possibility that when a company losses get this bad, how can they? It's just very few things they can do to avoid losses by not shutting down and producing at all. But it can be done. By shutting down, you can reduce your variable costs to zero. And what does that mean? Well, your variable costs are the cost of operating, basically. You know, labor, utilities, expenses around the business themselves that are monthly, and they are never the same from month to month at points because they vary. Um, However, there is also fixed costs. Now, fixed costs do not change. You have a monthly mortgage, you have monthly taxes, etc. Those are fixed costs. So, what a company has to think about when it's actually trying to minimize its losses is broken down into a couple of different scenarios. And it's really based, if the firm produces a quantity of zero, it could actually make losses because it would still have to pay for its fixed costs. In other words, even though they do nothing in terms of sales, they're in trouble because their fixed costs have to be paid. All right, now let's look at that at a closer view because that's where it gets a little confusing. When a firm has losses, it's got to face the question: should it produce or should it shut down? All right, so that's where we are now. Should the firm making losses produce or shut down? I give an example of a yoga center here, which has signed a contract for rent for $10,000 a month. Now, when the firm is operating, whether it's operating or not, actually, uh, it has that cost. That's a fixed cost. However, it has marginal costs and or variable costs, whichever way you want to look at them. They fluctuate of salaries for teachers, yoga teachers, and that is a $15,000 bill per month, roughly. I mean, that seems to be what they average. Now, if this firm shuts down, it still has to pay for its rent, but it does not necessarily need to hire labor. And that's one of the ways that it will start to reduce its losses. Let's take a closer look. There are three possible scenarios, all right? And that's what this is really all about. What are the three scenarios? The first scenario, let's scroll this up a little for you, is that the yoga center doesn't have any clients. So it doesn't make any money whatsoever, in which case it faces losses of $10,000, which are equal to the fixed cost. So it's losing the fixed costs every month: 10,000, 10,000, 10,000, 10,000. It's not losing the salaries because it doesn't have any clients. It's not involving any other miscellaneous costs. There would be miscellaneous costs, but it's not involving any other significant costs because nothing is happening. All right. The second scenario is when the yoga center does have clients, and those clients wind up spending or offering $10,000 worth of revenue over the course of a month to the firm, the yoga firm. Now, That's a monthly thing. But here's the deal. Ultimately, the firm still experiences losses of $15,000. Why? Because it has to hire yoga instructors for $15,000, and it has to pay its fixed cost of $10,000. So that's a total of $25,000 to operate. And the revenue, as it states right here, is only 10. So 10 from that $25,000 worth of expenses gives you a loss of $15,000 a month. All right, now you have the third case scenario. And you got to be asking yourself, how stupid is the second case scenario if you own the place? Well, that's not relevant to the discussion here. The yoga center now is in the situation in the third scenario where it earns revenues of 20 grand a month, but it experiences losses of $5,000. Now, how does that happen? Well, the $15,000 for the salaries and the $10,000 for the rent is $25,000 again. But it has revenues of $20,000 for the month. Business is picking up. And that can happen. That's why you monitor this stuff monthly. That means that 20 from the $25,000 worth of expenses leaves them with a loss now of $5,000 a month. So right now, believe it or not, that's the best case scenario. Okay, neither of those scenarios are good because in all of these cases, the yoga center is going to lose money. Now, here's the deal. At this rate, when the rental contract expires, and it's usually a year or 2 years or whatever, it's called the long run. When the rental contract expires and expense over the long run, assuming the revenues do not improve at all during this time, the firms in all three cases should exit the business. That's it. Done. Out. Okay? Now that's in the long run. All right? Let's look at it again, though, in the short run. In the short run, the decision can really vary. It depends on how much losses there were. We just talked about that. And whether the firm can cover its variable costs. The people, how many people you keep working for the yoga. You might want to cut that staff down. You have options there to cover that cost because it actually can be variable. Fixed when you keep a full staff, but maybe you have to start managing and changing the number of yoga instructors you have in order to try to minimize your level of losses. In scenario one, you can you're losing $10,000. If the center does not have any revenues and they're not hiring the yoga teachers, which would increase costs and losses, it should shut down and stick with only the fixed costs that they have on the short term and make some decisions based on each month trying to build the business up. That's kind of a dead end scenario, all right? But they've kept their losses to 10 grand. In the second scenario, you have a $15,000 loss. The center's losses are actually greater here, and it's still in business. It's greater because it does not make enough money to offset the increased costs of hiring instructors and still paying the rent. In this case, you got to shut down immediately. When the price is below the minimum average variable costs that the company has to spend, the firm's got to shut down. I mean, $15,000 a month is a shortcut to bankruptcy. All right? You thought that the 10 was bad, the 15 is actually worse. And here you've got people working and business coming in. That's what makes business a little complicated to make the decisions. Now you have the third scenario. The third scenario, the revenue that the seller can earn is high enough to keep the losses at their lowest point. They're diminished, and you can remain open, but you can only really remain open in the short run because as those losses mount up, again, you'll be heading directly toward bankruptcy. But again, it was a $5,000 loss in this case, which is the minimum loss. And maybe you can make some changes, or the market will change, or other business strategies can be put in place to change that because it's a smaller loss target to work with. Now, that's basically what this whole thing is about: short term shutdowns. Shut down with losses in the short term, but there are different decisions to make within that scenario. And the soundest one, of course, is the one with the least amount of loss. Something you can live with.